Hey, so rate cuts are happening. Most people are wondering what's happening. Rate cuts are happening. When I say rate cuts, I mean interest rates are coming down. A lot of people in my comment section have been asking what's happening. Interest rates are coming down. You keep talking about money market funds, talk about bonds, talk about treasury bills, talk about CDs. But rates are coming down right now. So what's happening? What advice would you give? Talk about rates. So yes, I'm here to talk about rates. Are you worried that rates are coming down? I know most of the time you're thinking, oh, I'm investing in my money market fund. I just started today, and then the rates are now coming down from, let's say, 14%, and now we're talking about 10%, even 9%. So rates are coming down quite rapidly. The central bank, of course, is the one in charge of monetary policy in the country. So they ensure that they cut rates according to economic outlook, according to inflation rates, according to so many things like unemployment rates and all those things, right? So either what they're trying to do is to stimulate the economy so that more people can borrow money and then invest and then, stimulate that economic cycle. Or sometimes they want to reduce things like inflation. They want to reduce too much spending, and so they increase the rates. So that means they will reduce borrowing and therefore reducing the amount of money in circulation. So that's the monetary policy, and that's how the central bank ensures that it can control money. Money is controlled. Any money that you see out here, all the money that the cash flow we have in the country is somehow controlled. Someone sitting somewhere makes some decisions and they say, hey, I think that we're having inflation rates at a very high level, so let's control this inflation rate. I think we're having very high unemployment rates, let's do this with interest rates so that we can, we can bring it down a bit. And that's how they manipulate and play around with the economic figures so that they can keep everything in check. And that's their work. Monetary policy. So right now as we speak, rates are coming down. We've been enjoying amazing rates in Kenya. We've been enjoying like up to 16%. I think treasury bills went all the way up to 16% at some point. Treasury bonds went up to almost 18%. I think actually 18%. The one I bought last was 18%. Money market funds have been ranging around 14%. Some went up to 16%, honestly. And that's really amazing. That's really good for money market fund, really good for passive investment that you don't have to do anything on. So those are some of the best rates I think we've seen in the country in a long time, at least maybe before I was born, but at least in my adulthood, we haven't seen such amazing rates. But now what's happening in 2025, things are coming down, rates are coming down. Are you going to be losing money? Where should you invest? What advice do I give you as rates come down? If you have checked your money market fund, you've seen that you are getting, let's say, 14, 15, 16%. Right now, probably you're at 10%, and sometimes even going to 9% for some of them. If you get the old ones, the established ones, like Old Mutual, CIC, Jubilee, all these ones, you will find that their rates will be way lower. So if you find some like Saiton, Zimele, Etika, these ones might still be on the upper, two-digit level, but they will come down. Rates are coming down. Of course, they're coming down in line with the central bank rate cuts. Now, you as an investor needs to start thinking about how to navigate rate cuts. You need to understand that this thing wasn't going to last forever. I did say this so many times that, hey, take advantage of these opportunities, take advantage of these rates that we have currently in very simple investments like money market funds, like T-bills, like bonds, and make sure that you get as much money as you can. But now as rates are coming down and you want to get higher returns, obviously, you don't want to be getting like 9%. You'll be like, Ken, I put 100,000, I'm only getting 9% in a year. I'm going to get less than 10,000 in a year. What kind of money is that? So obviously you want to get more for your money. You want your money to keep working for you. You want to get more opportunities. You want to make more money from your money. And that's the goal. You don't want to be putting a lot of money somewhere and then you come in later after a year or 2 years and then you have nothing to show for it. Everyone is looking for better, right? Remember, at Kensmoneymatters talk about the money mindset, how to make that money, how to enjoy that money, how to manage that money, how to invest that money, and how to assure yourself of a lifetime of income, basically financial freedom. So welcome to Kensmoneymatters, guys. What should you do in this case? I know it's really sad to see that you are at 14%, now you're at 9%. Bonds are also coming down. T-bills have come down from highs of 16% in early March 2024. Now we're talking about 9%. For the first time, the 91-day T-bill auction was at 9.58%. I think maybe even less. Then the 182 one was at around 10 point something percent. Then the 365 one was at around 11%. Now, comparatively, this is very low compared to the T-bills that were auctioned before. And T-bills are a very good measure of interest rates because, again, they're not too long term, right? So they can easily move with the interest rates based on the central bank policies. So in that sense, I would say the first thing you want to do is right now it's time to start rebalancing your goals, rebalancing your portfolio. Go back into your portfolio, rebalance it based on the rates. You don't want to making very little money and you have a lot of money kept somewhere. So this is the time to rebalance, rethink your goals and objectives, right? You want to rethink, what is my plan with this money? If it's a short-term plan and you want to spend the money somewhere else, well and good, you can keep it in these low rate areas like money market funds. But now if you want to start thinking beyond money market funds, beyond T-bills, beyond all these CDs, for instance. You need to start thinking ahead. Now, the first thing you want to do is realign your goals and objectives. Look at your portfolio. What are your goals with that portfolio? What are your objectives with the portfolio? What now do you want to do next, and how can you realign them? These are very normal thing that investors should do. You should sometimes look at your portfolio, the performance of them, and then rebalance them based on the returns you're getting, based on your objectives and plans, based on when you want the money, based on your goals with that particular amount of money or investment that you have. Rebalancing of your portfolio should be a very common thing. You're like, okay, I was getting 15% in a money market fund. It was good. I didn't want to go into a long-term investment because then it was easier to access my money, easier to invest in a money market fund, easier to compound it while getting almost similar returns as, let's say, long-term investment. But now things have changed. Maybe I need to take this money out and put it in a more long-term investment with a potential of higher returns. So the first thing is rebalancing, rebalancing, rebalancing. Very important. And then the second thing I mentioned is look at your objectives, your goals, rethink them. See if you can change a few things here and there. As you rebalance your portfolio, you must align them with your goals. So the second thing is realign your goals, your objectives with your money. If you had set some money aside and you haven't even done it yet, or some plans have changed, this is the time now to, remove that money and now say, hey, let me now properly invest it. If you are putting money somewhere, waiting for it to come down for you to make some moves, this is the time to take that money. So realign your goals based on the balancing that you'll be doing. The third thing you want to do right now is think long term. So you'll find that things like money market funds fluctuate a lot when it comes to rates, right? So it's going to go up to 9%, maybe even lower than 9%. So you'll be like, there's no money there. But if you go long term investing, for instance, if you go to T-bills that are like 365 instead of 191 day, or instead of the money market fund, you might be getting higher rates. So instead of, let's say, 9%, that is 91 days, you could be getting 11.6%, which is like a year, right? So if you have no plans for the year, you can then put that money into a higher interest rate investment. And that could be a T-bill, and also could be something like bonds. Bonds could be longer term, 5 years, 10 years, 15 years, 20 years, 25 years, even after 30 years. But then you're likely to lock in good interest rates. Now that's very important, right? Because with bonds, you can lock in that rate. Even with bills, if you do the 1 year one, you are locking in that rate. You don't know how farther down the rates are going to come. So you want to lock it in as soon as possible. Think long term. Think of something that can lock in something good for you. If you decide you don't want to invest in bonds, it's too long term for you. If you decide you don't want to invest in T-bills, then you can go for certificate of deposits, which is basically just bank deposits. Negotiate with your bank a good rate right now before things go down, and then you can lock that for a period of time as long as you wish and as long as you agree with your bank. So thinking long term and thinking of investments that could lock some interest for you right now, because the fluctuation is not good for your investment, especially if you are heavily invested in, let's say, money market funds, or you are heavily invested in like 91-day or 182-day T-bills. You want to rebalance that and think long-term, and then bring some money into this long-term investment. So people like us, for instance, who locked in good money for bonds, we are not worried about rates right now. People who locked in some CDs with a good rates, they're not worried right now. People who locked in some good investment in T-bills, they're not worried about rates right now. So right now, as they are coming down, and as we are still in that nice zone, you can lock in some investment. Start thinking long term. Then the other thing is think of diversification. Diversify. Go into something like growth funds. There are so many funds being offered in Kenya. I've spoken about some of them like Mansa X. There's another one, I can't remember the name now. But there are many different funds being offered by different banks, different brokers. This is the time to now start thinking, what other investments can I get that are not just related to these, bonds, money market funds, T-bills, debt securities essentially? Which other investment can you get right now that could take you to that next level? Investments that could give you some better returns than what you are getting. And those investments are likely to be a bit more risky, obviously, but you must now be ready to take that risk and, diversify your money. So look for funds that could be investing in foreign stocks. They could be investing in forex, they could be investing in other things that could give you more returns than just this normal guaranteed returns that debt securities do give. So it's all about diversification. Think diversification. Think of things you haven't thought about. Think of things that could actually help you move that needle a bit instead of just sitting in a money market fund getting your 9%. So right now it's time to look at other funds being offered by other brokers. It's also time to look at other stocks as well. And following up on that, you could also look at individual stocks. This is the time to go risky. Look at stocks that you think could be doing well in the next few years. AI stocks, data stocks, machine learning stocks. Look for all these things that could then give you some good growth. They are risky, but they give you a potential for higher growth, right? So this is the time to now go into individual stocks if you can. Look for investments that have higher potential for growth right now, but also they have a potential for downside. The same way they can give you very good money is the same way you can lose money. So if you don't want to go to individual stocks, I've just mentioned you can look for funds. Funds are baskets of stocks. They're already selected for you by managers. They are also managed by professionals, and therefore you're not worried about what to pick, what stock to pick. But if you want to be sophisticated, then go into proper individual stocks that you feel will be here in 10, 20 years. I always advise you this thing. If you use it, you can buy it. If you use it every single day in your life, you can invest in it because it's been there. There are things we've been using since we were born. You were born, you found maybe Facebook, you found WhatsApp, you found Instagram, you found YouTube. All these things, you can invest in them as individual stocks. There are things you use around you, cameras, computers, all these things. Look at the things you use in your daily life and invest in them. So that's another way and a very simple investment advice if you want to pick individual stocks. Then, of course, you might want to capture high dividend paying stocks. High dividend paying stocks would be very good for cash flow. These are some of those stocks that can give you very good returns, especially in a low interest rate zone, because then the company keeps doing well. It keeps making money, you keep getting your dividends. It gives you very good cash flow, and that's the time that you're looking for proper growth. And high dividend yielding stocks will give you really serious growth. So if you're looking for another option, look for dividend paying stocks as well. That's another way you can make money while you are also enjoying that appreciation as well. So you're making money two ways. This is the time when you're having low interest to look for these high dividend paying stocks. I've done a video on high dividend paying stocks in Kenya. You can watch that video and make sure you choose the right ones. Then you can go into other investments that are a bit more complicated, like REITs, real estate investment trusts, whereby you're investing in real estate but don't actually buy physical properties. That's another way you can actually get into very sophisticated, nice investments, because real estate will always be doing well, likely to be giving you very good dividends as well, likely to give you that protection against, very, very low interest rates, because then real estate will always be appreciating. People will always need housing. These things will always remain steady. So you want to go into things like real estate. If you are being more sophisticated, you can go into things like oil and gas, things that we use every single day. But try to be aware of what you're investing in. Don't just invest in something for the name of it or for the sake of it, just because you want to say, I'm investing in this. But try to understand what you're investing in. Again, for those who are more sophisticated, you can go into things like crypto. This is the time to now leverage your investment. Make sure you're getting something that could give you higher returns. So like I said, crypto, again, I've done a video on that. You have to go there knowing exactly what you expect. It can go to zero, it can go high. That's also a very risky investment. But like I said, it's time to now try to diversify, time to have your risk tolerance higher than it was before, because then you are chasing those high interest rates. The moment you're chasing high interest rates, you're going to have to allow yourself to have a little bit room for risks. So last but not least, ETFs, exchange traded funds. So even if you're looking for more options, you have ETFs. You don't want to pick stocks. You don't want to go into all those funny stuff like crypto. You want to look for very normal things, and you also want someone to do the work for you. Look for exchange traded funds that are selected for you already. Very low expense ratio, very easy to invest in, because you know what, the basket is already made for you. It's a basket of stocks. Someone has chosen it, someone is managing it, and you have to pay very low expense ratio. So ETFs could be a very good way for you, because you can end up mixing consumer goods. You can mix companies that are health related, consumer related, IT related, anything basically that you might want to add into your basket. You will find these ETFs in different platforms. Make sure you get a good one that you can invest in. So these are some of the areas you can get into as we are experiencing these low rates. Sometime maybe these things will change again, the rates will go high. This is how economic cycles are, but you have to be prepared as an investor for all seasons. You can't expect things to be high all the time. We knew that rates would come down at some point. It's time that they have come down, and therefore you as an investor need to rethink on how you're investing. Now, one important fact that I want to mention is always it's a good thing to start a business. Invest in a skill or start a business or something that can give you more money. As rates are coming down, all you want is higher cash flow, right? You want more money that you can invest, because the more money you invest, the more returns you can get, even if the rates are lower. But right now, if you have very little money and the rates are low, you're making no money basically. So you want to increase your income potential as well. You want to increase your opportunity to get higher rates even with a business. So start a business idea, start a side hustle. This is the time to get busy. So let me know what you think in the comment section below. Where do you think the rates will be going to, and where else do you want to look into? Business, investments that I've mentioned. What are you doing about it, guys? Till next time, I'm out.